Hi folks, I'm Doc from Ready Set Trade. In this video, I want to show you how I made $17,000 this month, mostly from doing nothing. I got these returns using a strategy that anyone can do and one that I've been using for the past 15 years, but I've made a recent tweak to this strategy lately that I want to share with you today. The challenge for retail traders is to get those winners to be bigger than the losers and have more of them, so you can get a net positive return. Skill and knowledge are important to that goal, but the simplest and most effective way is to put the probabilities in your favor when you trade. In this short video, I'll show you how to do that, plus show you the small change that I made recently that's made all the difference. Any of these individual trades that I'll go over here could have been made with an account of 18,000 or less, or significantly less actually. If we go down to one contract, having these trades in play concurrently, though, did require significantly more capital. So I just want you to understand that we didn't make all of these trades concurrently with a $1,000 account. To apply these trades to your own situation, adjust the contract size up or down. It's extremely important to trade within your own means and to understand your trade risk to the penny. One of the key strengths of this trading strategy that I'll cover today, which is called the cash secured put option, is that I'm a willing buyer of the stock if it comes to potential assignment. You'll see what that means in a minute if you don't understand that statement. This puts me in a much stronger don't care mindset when it comes to the price movement of the stock. I just don't care if it goes up, down, or sideways. The mental freedom of don't care means that these trades truly generate passive income, which is being able to make money while you sleep. Let's look at a few of these trades that did most of the damage for me this month. Our first example is Fisker. This is a new stock that went IPO this fall. Originally was a SPAQ, or Special Purpose Acquisition Company, with a ticker of SPAQ until they went IPO this fall as Fisker's FSR. This trade we first started on 17th of November. What we did was we sold the cash secured put for the 18 December cycle. The idea behind this put is that we got paid to commit to buying FSR stock at $12.50 a share when it was already up here at 16 and change. Now, if the price goes higher from here into expiration, we keep the credit, nothing happens, our obligation is released. If the price goes sideways, nothing happens, our obligation is released. Even if the price goes somewhat down in towards expiration and closes above $12.50 a share, our obligation is released as of the 18th of December. It's only if the price gets down to about $12.50 or lower by 18th of December where we may be looking at potential assignment or owning the stock. But guess what? We get paid to do that by accepting the credit to begin with. So our cost basis is actually much lower than $12.50 a share. Let's look at the numbers. On the 17th of November, at the $12.50 strike, we were paid $105 per contract to enter this trade. So we brought in for 10 contracts, $1,050 of credit that goes straight into your account right off the bat. That's cash that you can do anything with. We ended up closing the position on the 14th of December for a 6-cent debit just to clear the margin for that because we have another trade in play, as you'll see in a minute. Our net profit on this trade was $990 or 7.9% return. Try to get that from a bond or a savings account these days. That's true passive income. We did not have to do anything at all after the trade was set up. Here's the next example, and as you'll see, we light these trades up and we do these in a leapfrog fashion. We can actually have a couple going at the same time. Sometimes we'll close down one of the original ones so we can light up the next cycle, and so we can play in a leapfrog fashion if you have enough capital to play this. On a pullback on the 30th of November, so this had transitioned into an uptrend again. On the 30th of November, we once again sold at that $12.50 strike, this time for the 15th of January. So we had slightly longer hold time for this. Again, same rules here. If the price goes up, nothing happens on the 15th of January. Obligation is released. If the price goes sideways or even down quite a ways, we still have the obligation released on the 15th of January and we do nothing. It's only if the price goes all the way down here to 1250. By the 15th of January, are we open for potential assignment? Let's see how this one resolved. 30th of November, we got $1.30 credit this time. So on 10 contracts, we pulled in 1,300. The position is still open today as of 12/27, but we can close it for a 30-cent debit. The unrealized gains are $1,000 right now, or 8% return. Don't forget that I'm a willing buyer of the stock. So if the price does come back down to here, that's fine. I'll buy it. But more than likely, I will look for a cheap exit so that I can cycle that capital back into play. And there's a third trade in play. On the 21st of December, we once again went after that 1250 put, which is going to expire on the 19th of February. So we're about 50 days away from that one. We entered the 21st of December, 1250 puts. We got $1.20 credit. So on 10 contracts, we brought in $1,200. Position is still open today, but we can close for a $1 debit. So unrealized gains are only $200 right now because we've only had the position open for just a couple of days. But once again, as long as the stock goes up, sideways, or even down quite a bit, the position will expire as of the 19th of February. And it's only if the price comes down to 1250 or lower, which again, I'd be a willing buyer of, that I will be assigned the stock. And if that's the case, my cost basis is actually well below there now because of the recent trades that I've made. I've earned all this credit and I've dropped the cost basis. So if I am a buyer at that point, if I do own the stock, then I'll be in a very strong hand position. Here's the current chart today. As of when I'm recording this, you can see the 3 entries that we made, and all of them are either closed or in a strong hand position where I could either take them off now or let them cook a little longer into expiration. Let's look at our next example. I'm going to go through these quickly now. This one is for MP Materials. This is the new IPO stock, which was formerly FVAC. That's the SPAC, or Special Purpose Acquisition Company, which IPO'd as MP. This is a battery materials company. And here's the trade that we took on there on the 1st of December. We've got a stock which is transitioning into an uptrend, pulling back and allowing me to sell the 1750 put. This is a little more aggressive because it was fairly close to the money for this, and the same conditions exist. If the price goes higher from here, sideways, or even slightly down, we can more than likely let this just expire out of the money. It's only if the price goes to 1750 or lower that we're looking at assignment. In this case, on the 1st of December, we entered those 15 January puts at the 1750 strike for $1.80 credit apiece. So we brought in on 10 contracts, because we were a little more aggressive on our entry, brought in $1,800 of credit. Position is still open today, but I can close for a 5-cent debit, which is something that I'm going to do more than likely tomorrow when the market opens back up again. Unrealized gains are 1750 or 14% return. So again, I'm a willing buyer of this stock, but at this point, it doesn't seem to make sense to stay in there for the next 3 weeks. I can close the position for 5 cents or less, so I can free up $17,500 in cash margin over the next 3 weeks. So what you have to ask yourself is, can I use this $17,500 in cash to make more than $50 over the next 3 weeks? You bet I can. So this is opportunity cost to hold the position at this point. Here's what the chart looks like today. You can see a very strong rally since the point that we entered on MP Materials. Every pullback is being bought with both hands. Okay, I know you guys are starting to get it now. You're starting to understand how this works. So I'm going to speed up a little bit on the next example here. This is SRAC. This is a special purpose acquisition company, or SPAC ticker, for what hopes to be Momentus at some point, which is not yet IPO. So we're still trading the SPAC, which, oh, by the way, has options. So in this case, on the 11th of December, we did the same thing here. We sold a 1250 put down here for the 19 February cycle. So ways out, we sold a little bit of time here, but got a really very nice strike price for this. I'd be a willing buyer at 1250. Let's look at the numbers here. On the 11th of December, we entered the 1250 puts for a 235 credit. So in this case, for 10 contracts, we brought in $2,350. Position still open today. I can close for a 60-cent debit. Unrealized gains are $1,750 or 14% return right now. So 54 days to expiration. There's a long time to hold to make an additional $600. I'd like to get a piece of that, but I will look to close the position fairly soon. And the reason is because we've had a heck of a rally from here. Nice higher low, higher high transition into an uptrend. Strong rally from here. Positions like this, I like to close into strength. Our next example is GHIV. This is another SPAC or special purpose acquisition company. And this is a ticker which hopes to be United Wholesale Mortgage IPO coming up fairly soon. So in this case, on the 9th of December, we sold the $10 put all the way down here, which is fairly conservative, seeing that most SPACs have a $10 price floor. So it's almost like money laying around on the ground that you can pick up. We sold this for the 15 January cycle. So on the 9th of December, we sold the $10 puts for $1.50 credit that brought in $1,500, just laying on the ground. Position still open today, but I can close for a 15-cent debit. Unrealized gains are $1,350, 13.5% return. Try to get that with a bond or a savings account, forget it. So I'm a willing buyer of this stock, but I'm likely to close the position for 10 cents or less this week, which it more than likely will hit, so that I can free up that $10,000 in cash margin and recycle this. Here is what the current chart looks like for GHIV. You can see for the entry point here, we have a nice higher low and an extreme rally to the upside. We do like to sell these positions on pullbacks and close them into strength, which is why I'm going to be looking to close this down here fairly soon. Okay, I hope those examples made sense and you can see why I had a good month. So let's wrap things up. Let's conclude things with the keys to success and show you the tweaks that I've made. So we've been using the cash secured put option strategy to put probabilities in my favor. I hope you can see that this gives you so many different ways that you can make money, whether the price goes up, sideways, even down quite a bit. I have so much to work with here that I can be wrong in so many ways about the forward direction on the price, and I can still make money. It's only if the price goes significantly lower that I'm looking at a potential assignment and or potential loss condition on the trade. So I've seriously put probabilities in my favor on every single one of these trades. One of the biggest changes that I've made in doing this strategy is I've been doing this for 15 years now. It's only been recently that we've had these SPACs, which have turned into new IPOs in a very different method from the traditional IPO. Traditional IPO is usually bid way up here, and from day one, this thing is in trouble and has to go way down here, establish a new base, and then you can start to trade something like this. But with SPACs becoming new IPOs, they're generally starting at a much lower price point, so we don't have that asset inflation like a traditional IPO does. So we're using stock candidates that have a strong IT value, right? EVs and new battery technology companies and new forms of bringing value. These are all disruptive technologies that we're looking to do. So we get the herd of retail traders to help us speculate on these trades and push the price around. So we're establishing the position on a pullback as well too. I think this is extremely important. A lot of retail traders tend to chase after something that's moving like this. We're always waiting for the pullback so that we can get a much better position in play. And that also increases the implied volatility, making this position down here worth so much more because of the option premium that we're selling. This last point here is extremely important. We have the strength in mind to know that we're going to be a willing buyer. So we don't do this on just any stock. We do this on the IT stocks that we want to potentially own down the road someday and think that they could be disruptive multipliers for capital gains down the road. This gives us a huge edge that we can just let the price do whatever it wants to do without really worrying about what's happening on a day-to-day basis, which is usually the case for most directional swing plays. Hope you enjoyed this video and got something out of it. If you like what you heard, consider joining our 10X tribe for free today. Go to elite.readyset.trade. And once you bring up that site, scroll down to the bottom, choose a membership plan, and look at the left-hand side. Join our 10X Tribe membership for free. All you got to do is hit that access button, and you're going to be on board in a few seconds. We'll see you there. Thanks again for listening.